So before we dive right into it, I am very, very excited for today's session. Last week we did have a session, but today we're going to make it more engaging. I would really love to listen from you a lot more and understand your get to just listen your questions and also get them answered. Yeah, it's my hope and prayer that by the time you end the session, you have known something, even if it's just one thing. Let it be which let it enable you to really start off and make informed investment decisions in this financial asset space. There is no better time and no better place to have such a conversation, such an impactful conversation, and would like to also appreciate NSSF for giving us this opportunity to share to a larger group of people about these investment opportunities, and to our different stakeholders, Bank of Uganda and the Ministry of Finance. We do honor you, and we really, really appreciate what you're really doing. But before I start, I would like to say, why do we actually do such a thing? Why do I actually offer this service? Now, a lot of people out there in the market, the Treasury Bond and the Treasury Bill space has become really, really popular in Ugandans, and we have seen an increase in the number of people that are actually going into these investments. However, how informed are you about them? Do you know the risks attached to them? Do you know how to take calculated moves when investing? When can you buy a bill or a bond? When is it best for you to sell? How do you use pricing to your advantage? There is a lot. It's not just a matter of the interest that you're getting. There is a lot that is at play that you need to know. And that is why you actually really do need someone that is doing this and is actually practicing this on a daily basis. So that is why I actually do it. We do it to actually help you make better informed decisions, but also to maximize your returns in this area. So to dive right into it today, we're going to understand Treasury bills and bonds, and also put in a mix of the unit trust funds. My name is Elijah, for those that don't know me, and I am on different social media pages. I am on X, I am on Facebook. I rarely use Facebook. Right now that in Uganda, you have to use VPN, really. On Instagram, and I am really so much onto the LinkedIn space. And yeah, I currently serve and head the advisory team at Legacy Hills Investments. And we have literally advised over billions of shillings in the bonds, and also helped a lot of people make informed decisions in selecting the right unit trust funds that align with their goals and objectives. So going straight into today's conversation, we're going to talk about financial assets, but we're going to start at the very top, okay? What are these different financial assets that are there, and how do we actually categorize them? At the topmost, we have what we call debt securities. Now, debt securities is where basically you're lending money for an interest in return. Okay, those are those that we call the debt securities. Then we have what we call the equities securities. The equities is basically the stock market, or other people call it shares of companies. Here you're buying a piece of a company in exchange that they will give you the profits that the company has made in that financial year. Then we have what we call derivatives. Derivatives are sort of a bit complex, but we base the value from different underlying assets, and then see how they've actually performed. And then we have alternative investments, which is, if not the popular investments right now that we know of, things like real estate, things like commodities. With commodities, we're talking about agriculture. You plant matoke, you're going to sell it off, you do maize, you're doing coffee, etc. is all under alternative investments. But also part of alternative investments is insurance. But insurance is protection. We'll highlight that later on in case you would like to know more about that. But yes, those are different categories of under the investment universe. They're basically for. But today's conversation is going to heavily rely on the debt securities. Now, on Wednesday, we did have an auction by Bank of Uganda, and I saw the results, and I was really so surprised. First of all, Ugandans have money. Wow, people have money. Yeah, we transacted over 1.1 trillion. That is what they had collected as BOU, and it was really amazing to see people really get invested into this 15-year bond. But today we'll learn more about these different investments. Now, going right into it, what is a treasury bond? What is a treasury bill? Now, a treasury bond is a debt instrument. It is a tool that governments and companies use to borrow money from the public. Okay, so usually there are three ways the government of Uganda raises money. The first one is the most popular one, and that's through taxation. And then we do have foreign debt. They can take on foreign debt. That means they could go to the US, they could go to China, etc., take on debt and then pay them back. The third one is domestic debt. Domestic debt is where they are now borrowing from the public, and that is where now the bonds come in. Now, it is just a tool that the government will use to pull those resources from the public, okay? So this is actually an advantage to us. There is a demand from government that they need resources to run their different projects, okay? And you have the supply, okay? So this is an opportunity for you to come in, and it becomes an investment opportunity for you. You give them the money and you hope that they're actually going to give you. The government actually commits to paying you a certain interest rate every after a certain period of time. Now, what is typically the difference between a bond and a treasury bill? A bond has a maturity of between 2 to 20 years in Uganda, and a bill starts from 3 months, 6 months, and 12 months. That's the first difference. So bills are short term, bonds are longer term, 2 to 20 years in Uganda. The other second difference is on the payment methods of how actually these investments are paid out. Now, on a bond, coupons are paid out, or interest is paid out every after 6 months. So every after 6 months, you're going to get a coupon to your bank account. Then for a bill, you'll have to wait till the end of your investment period. That is, if it is 6 months, you're going to have to wait for all the 6 months to come to an end or to mature for you to make that profit for you. Now, a treasury bond is issued at what we call a discount. Okay, the commonest example I would literally use is land. Okay, because at least all of us in a certain way have interacted with or have heard of someone buying land. So you go to a friend, and a friend decides to lease you land worth 20 million shillings at 15 million shillings, okay, for a year. So you paid that 15 million shillings, and after a year, or after the 12 months, your friend comes back and buys it at 20 million shillings. That spread of 5 million, or that difference of 5 million, is your profit. So that is how typically the treasury bills work. For the bond, every after 6 months, you're going to be getting an interest payout to your account. Okay. Now that we've understood what a treasury bond is and what a treasury bill is, let's now go slightly deeper into pricings of bonds. How are bonds priced? Okay. How do we come to those rates and etc.? How much do I actually? It comes to how much now you're paying for a bond, and to actually get what you're getting. Now, bonds are priced in three different ways. Okay, so we have a bond that is trading at par. Okay, I'm trying to avoid using a lot of financial jargon here. So by trading at par, what it actually means is that you are the coupon rate or the interest rate that you're getting matches the market rate, okay, of that bond. So in the market, let me try to explain this. In the market, there is we follow the rules of demand and supply. Okay, when there is demand and when there's demand and the supply is equal, then there you're actually just going to match, meaning that bond is at par. Okay, but this brings me to the second one. If your bond, your coupon rate, yeah, is lower than your yield to maturity, or what we call the market value of that bond, meaning that bond is going to be at a discount. Okay, the first one is trading at par. That means it is equal. The second one is trading at a discount. A discount, you are actually going to pay way less for the bond than its actual market value. For example, back to the example of land, the market value of land, let's say in Mbarara, is 20 million shillings, a 50 by 100, and then you're actually going to buy it. Someone decides to discount it to you and give it to you at 18 million shillings. In actual stuff, in actual sense, the real market value is 20 million, but you have bought it at 18 million. So that is the second way bonds are price. The third one is on a premium. Now, the premium is where the coupon rate or your interest payment is greater than what we call the yield to maturity. The yield to maturity is the market rate of that bond, or how the bond is literally performing in that market at that very time. Now, back to the same example, you land in Barra, let's say it's still 20 million shillings, that's a market value, but then the person selling it to you decides to sell it to you at 25 million. So you're going to buy land that is worth 20, in actual sense, worth 20 million shillings at 25 million shillings. That means you bought it more expensively. Okay, so that is differently the different pricings on bonds. There is par, there is a premium, and there is a discount. Now, which one is good? All of them are good, by the way. It's good to have a mixture of all of them in your portfolio. Okay, usually the par is when they're doing a primary auction. You find it's at that moment it's at par in most cases. However, there are cases where it also trades at a discount. For example, the last auction, it was trading at a discount. Those definitely happen. So what is the advantage of a discount? What's the advantage of a premium? The discounts, the first thing is you are buying a bond much cheaper. Okay, you're paying way less than the actual value of the bond. So that means you're already making literally a profit at the very start of your trading. And then when it comes to the premiums, before I go to the premiums, the disadvantage of the discounts, I would say just a slight hiccup on the discounts is that the interest payment on it or the coupon rate may not be as high as the one of a premium. Okay, so you find that the one of a discount is giving you 15%, and the premium bond is giving you 16.5% or 16%, which is like 1% higher. Yeah, but with a premium, you're going to pay more expensively for it. That is literally the downside of it. You're going to pay way more expensively for it, for just a 1% or a 2% increment in your coupons. Yeah, but both are good. It's good to have actually both in your portfolio, or a mixture of both. Yeah, they all have different roles that they actually play in your portfolio. Premiums will give you very good interest payments compared to discounts, and you know that at least you're making way more money. Yeah, so that is literally the pricing on bonds. Now, before I move off from this slide, prices of bonds change on a daily basis. Okay, you're going to go to a trader or to an investment advisor. They'll make you a quotation as of that day, and they tell you, okay, you are buying a bond worth 100 million shillings. You're going to pay only, let's say, 95 million. Tomorrow, you're going to go. If you don't come in that day and you go in the next day, you're going to find that the prices have actually changed. You may find yourself paying slightly more because the price has changed. So prices of bonds change on a daily basis. And before you actually trade in bonds or ETC, seek proper specialized help from investment advisors. Okay, either contact me, contact someone that you really trust to guide you and advise you on which bond is good for you, when to step in, when to get out, things like that. There's a lot more about a bond than just the coupon alone. Yeah. Now, this is a typical example. What you see on the screen is a typical example of a bond. Okay. We already know the year to maturity. So, for example, let's say this is a 20-year bond, and you're starting on a Thursday. Okay. The coupon rate is 15%, but your YTM, which is the yield to maturity, is 16%. As I earlier said, if your yield to maturity is greater than your coupon or the interest you're taking, meaning that that bond is at a discount, you're going to buy it cheaper. Okay? So you're saying that the nominal, I was giving the example, your nominal is 100 million shillings, or your face value is 100 million shillings. That means this person at this moment will be paying only 96 million. Okay? Meaning we have saved this person about already 4 million shillings, approximately 4 million shillings, because they have taken on a discount. On the other side that you see, which is your right-hand side, you're going to see the coupon payments that will be coming after every 6 months. Okay, in June, in December, in June again. After 6 months, this person will be getting their coupon payments to their accounts. Okay, so this is the example of a discount bond. For a premium, just know it's the other way around. That 16%, the coupon rate will be way higher than the yield to maturity, or the YTM. And that means you're going to pay slightly more expensive. So if this person was buying a premium bond that was giving them 17%, you'll find that they're actually paying they had initially planned to pay 100 million, but they will pay about 110 million shillings. So that 10 extra million that you're paying is a premium for that bond. Okay, so those are just some of the things about bonds, or the things that you should actually know before going into a trading of bonds. And for those that have really traded in them, at least already know these things because they've seen it themselves. Now, as for a bill, the bills are auctioned at a discount. Okay, as earlier said, you buy it cheaper and then you wait to maturity. That is when you get the full value of that bond. So if you buy a bill at let's say typically 98,000 shillings, after 3 months they may give you 100,000 shillings. That is a spread of 2,000 shillings that you made as your profit on the bill. Once more, the bill is shorter term, the bonds are longer term. That is why the bonds will give you more higher interest payments compared to the bills, because the bills are shorter term. And to the tax element, before I move forward, to the tax element, now that the treasury bills and part of the bonds, that is from 3 months to 5 years, you're going to pay a withholding tax of 20%. Okay. And then from 10 years to 20 years, you're going to pay withholding tax of 10%. So the shorter the investment, the more you're paying in tax. The longer the investment, the lower you're paying in tax. Okay. So the amount you receive to your bank account is less by the withholding tax. Okay. Depending on the period that you are investing in. Now, let's go into the real world application. How do you actually use bonds to fund your regular lifestyle as a Ugandan? Okay, we're going to start by someone that has, you have your expenses for 6 months, 12 months, you already know. So what you can do is sit down and you know that every month I spend 2.7 million shillings. That is on the car, on rent, on meme, etc. Okay, and wedding, those miscellaneous, events that come up. Okay, you sit down, I know every month I am spending 2.7 million shillings. At the back of your mind, you know that the government of Uganda pays you a coupon after 6 months. So multiply that expenditure by 6, so you'll get 16 million. If it's 10 million, you'll get that. Okay. And then you'll have to look out for a bond that is able to pay you that amount of money, or you have to build a portfolio of bonds that is able to pay you out that amount of money for you to enjoy as a passive income. Okay. The other way is what we call bond laddering. Now, bond laddering is where you stack up bonds in a way that they give you monthly payouts. Okay. As I earlier said, bonds pay out every 6 months. And you already know that, if I was just give you back this example, that you see that this type of treasury bond is paying you in June and in December. Okay. So on bond laddering, you already know you have a coupon coming in June and in December. So you have to find another bond that will pay you in January. You get another one that pays you in Feb, in March, in April, in May. So you find that you are having coupons coming in every month that are able to fund your lifestyle. Okay, so this is what we call bond laddering. And for you to get this from an advisor to help you actually select, to scout the best prices for you and know which one will do best and which one will be paying out in what month for you. Okay, so bond laddering is very good for people that want to retire and they want to use this as a means of passive income. But even if you're a business owner and every month your business may need more money to be injected into, bonds are one of the methods. Bond laddering is one of the methods you can actually use to fund your business, your lifestyle, anything, of that sort. Now, bonds are not as rosy as we think they are. There are definitely risks to every investment. Yes, bonds are the safest investments you may find out there, one of the safest investments. However, there is a bit of the risk element in it. The first risk I would like to start with is on your right-hand side, and that is the inflation risk. Now, inflation risk is basically where you are investing in a bond that is trading lower than the current inflation rate in Uganda. So let's say that typically the inflation rate of Uganda is 5%, and your bond is giving you 4%, meaning your money has lost value, or the amount of money you're making is actually making a loss during that period of time. However, the bonds and bills in Uganda is giving you as high as 9%, 13%, 15%, which is very good because they are trading above the inflation rate. currently in the economy. Okay, so it's a perfect investment for you. The other risk is what we call liquidity risk. Liquidity risk is basically where you bought a bond, which is worth 10 years, okay? But then in the fifth year, you want to sell off that bond because you probably got an emergency or because you've seen maybe a better bond that is trading that you'd like to go into. So you go to your bank and try to sell it off, and the bank decides to sell it. You end up selling it off at a loss. And number one, the bank is obligated to buy this bond from you. Okay, so sometimes the market conditions at that moment may not play in your favor, so you end up selling it at a loss. Rarely do people actually find the market playing in their favor. Okay, that's why they end up selling it at a loss. So back to the same point, get help from an investment advisor. They know when to tell you to sell off and when to hold. Okay, because they monitor the markets for you on a daily basis. Then we have what we call reinvestment risk. So here you're trying to copy what a unit trust does. So you get your coupon or your interest payment on the 6th month. For example, in June, you've gotten your 7 million shillings as your payment. Now you decide, since you've seen that your bond is doing typically well, you want to go and reinvest back into that bond. But what typically happens there is that, as I earlier said, that prices of bonds change every day. You might have bought a bond at a certain price, and the next time you go back there, it's at a different price. You may find you have to pay more expensively for it, and the conditions have changed. So that is what we call reinvestment risk. Okay, so things end up not playing in your favor at that moment. Then there's what we call a call risk. So here, the government decides to call back the bond before the maturity. Okay, so definitely compensate you and etc., but you would have lost out on the coupon payments that you would have made. Okay, so how does one get into bonds? How does one start the journey in the bond market? So the first one, you're going to, as I would start with, get help from an advisor, an investment advisor. Come to Legacy Hills. Go talk to your friend who is an advisor and actually does this trading on a daily basis to help you and advise you which bond is best for you. Secondly, go open up a CSD account. That is a Central Securities Depository account. Okay. And then after opening it up, the minimum amount you can start for investment is 100,000 Ugandan shillings. You open this CSD account with your primary bank. So if it's DFCU, Standard Chartered, Housing Finance, etc., just go to your bank, tell them you'd like to open up a CSD account, and then they'll walk you through the entire process. And then when you're ready to start investing, go ahead, select the bond that you'd like to invest in, and then start your investment journey. Now, that is the indirect way of investing in the bond market or the bill market, when you decide to go directly. But there's also the indirect way of you dealing with this. If you don't want to have a lot of, having to go up and down, choosing which one is good for you, the pricing, the back and forth, etc., unit trusts are there to actually solve that problem for you. So what typically is a unit trust fund? A unit trust is a collective investment. So it is where a group of investors with the same objective pool resources together, all that money together, and give it to a professional fund manager. Or in simpler terms, they give it to a person that understands investments. Okay, this person that understands investment, who is a fund manager, will allocate these resources to the different assets that were broken down. That's the Treasury Bonds, the Treasury Bills. However, they even go further to invest in more of near cash assets, things like fixed deposits of banks, call deposits of banks, and commercial papers. Okay, why they do that is because they know anytime you may come out for liquidity. You may be like, okay, I need my money tomorrow. Them investing in fixed deposits, in call deposits, etc., enables them to liquidate your assets very fast within 24 hours and pay you out. Even within just a matter of hours, they're able to pay you out. Okay, so what are typically the advantages of a unit trust? Quick access to funds, as I earlier said, liquidity. So you can get your money out within just a matter of hours. Okay, diversification of investments. So as I said, they invest in bonds, in bills, in fixed deposits, in commercial papers, etc. Okay, so that diversification protects you a lot from the different types of risks. Excellent returns. Majority of the unit trust funds in Uganda are giving you an average of between 11 and 12% on your investment per year. Not per month, per year. Okay, get that clear. Then there's expert decision making. Of course, these are seasoned investment professionals, so they're able to make professional and expert decisions on your investments. Flexible and affordable investments, access to your money anytime. So that's the quick access. Professional investment input. Your interest is also compounded on a monthly basis. Now, with this one, what happens with the unit trust on the compounding element on it is that when they invest your money today, okay, rates of, let's start by saying this, the rates of in the unit trust change every day. Or the rates in the markets change every day. So you would have invested your 1 million shillings today, and the interest rate of that day, the prevailing interest rate of that day is 12%. So they'll get that 12% divided by 365 days, and they will give you your unique return of that day. Okay, so on Monday you've made, let's say 1,000 shillings of your 1 million. Okay, so the next day is going to be reinvested. Okay, as 1 million 1,000 shillings to at a different rate. So the rate might have changed to like 11%, might have dropped to 11%. They do the same thing, so it ends up compounding, and that compounding helps you generate a lot of money in the long run. Unit trusts are both good for short-term and long-term investments, okay? But to harvest the best out of a unit trust and to maximize a unit trust, invest long-term. Think 5, think 10, think 20 years ahead, okay? So a lot of people will come to me and be like, okay, just calculate for me and see in a year, what do I get? Usually a year, yes, you'll get a bit of return, but not as much, because you would have missed out on the compounding effect, but you would have also missed out on the advantage of time, because time with investments, your investments will literally explode. The returns will be so good. Okay, so just visit our offices. I'll literally run numbers for you. For those that really want to go into the unit trusts and etc., I typically can run the numbers for you that if you invested this amount of money and the rate is at this, how much do I get in 10 years? How much do I get in 20 years? So we can run different scenarios for you, and you will see which one is best for you on your different goals. Now, there is the direct way and the indirect way. I've already talked about them. With the direct way, self-managed with limited bank advisory. Yet in the indirect way, you're having the professionals coming in to manage your investment. So when you go directly, don't expect people to, help you that much, okay? Unless you have gone through an investment advisor. But if you don't have an advisor and you've gone in all alone, yeah, you might have a bit of challenges here and there. Sometimes, not all the time, sometimes, but when you go through the indirect way, that's through the unit trusts, then you're already having professionals helping you. The other thing about the direct way is you're subject to withholding tax, which is not on the side of the unit trusts, yeah? Limited diversification, because you are investing in one bond, so you like literally putting all your eggs in one basket. But with the indirect way, your eggs are being spread in different baskets, so the risk is minimized. So there are very, very many comparisons between direct and indirect, and both are good. Direct is excellent, indirect is excellent. It all depends on your goal, what you want to achieve, your liquidity needs, etc. So still seek professional help to know which one would be the best for you to maximize the returns. Okay, so there are different fund managers on the market, licensed fund managers, and these are the ones that are licensed and regulated by the Capital Markets Authority of Uganda. Okay, we have UAP, the minimum is 100,000 shillings. Okay, we have Britam, the minimum is also 100,000 shillings. We have Zeno, which is the lowest on the market right now. Okay, so we typically have no excuse of not investing. Zeno is starting as low as 10,000 shillings today. And on your MTN, you're able to set up your investment account. Okay. Then we have ICEA Lion, 100,000, Sanlam 100, and also SBG, which is Stanbic Group Securities, starting at 100,000. However, there is one that's very, very amazing. I personally use this scheme, and that is the NSSF voluntary scheme. So over and above your savings with NSSF. NSSF already has a voluntary scheme that is running, and you can start as low as 5,000 shillings. Guys, it is very important that you also plan for your retirement. Now, all these fund managers are very good, okay? But you see, when you always have access to your money anytime, a lot of you are tempted to withdraw that money to use it for other things. Now, with the NSSF voluntary scheme, you're able to think long term, and they're also giving you that advantage of being locked in for a certain period of time. which comes into the financial discipline. End up thinking 5 years, you think 10 years, you think 15 years. If I contributed 100,000 every year for the next 15 or 20 years, what do I get? And the beauty is they're giving you an interest on it. So actually start up a voluntary scheme for yourself. So over and above what your employer is giving you, put away something. Okay, we all know what our employers are putting for us in our NSSF may not be enough for our retirement. So add something. Okay, you could do a payroll deduction, or you could just voluntarily every month pick from your bank account, send it to your NSF account. Okay, yeah. So that marks the end of my presentation. I will welcome questions and answers, and I'm handing over this to Audrey.